Hello everyone, welcome to this video. This is the next in the financial accounting series. In this video, we are going to focus on the various financial statement accounts and journalizing transactions, also known as using debits and credits. Okay, so let's do a super quick review of the financial statements. So at this point, we've determined that there are four general purpose financial statements. We have the income statement, the statement of retained earnings, or called statement of equity sometimes, the balance sheet, and the statement of cash flow. Well, now we're going to examine how information gets recorded and makes its way onto those financial statements. We are going to follow a simple process for analyzing and recording transactions. We are going to follow a 5-step approach: identify, analyze, record, post, and prepare. So let's take a moment to look at each of those steps. Let's start with identify. So first, we're going to identify each transaction and event from source documents. Source documents might be things such as sales invoices, bills that we've received, payroll records, bank statements, and other business records and transactions. From there, we are going to move to analyze. We're going to analyze each transaction and event using the accounting equation. This is where we are going to identify the accounts affected by the transaction. For example, if a customer makes a payment on an invoice, we might decide that the accounts affected by the transaction are cash and accounts receivable. We need to increase cash and decrease accounts receivable based on this cash receipt from the customer. That's just one example, and we'll look in just a moment and see how to record specific transactions. Now, let's look at the remaining steps in this process. Let's look at record. We're going to record relevant transactions and events in a journal. This is where you generally hear the term debits and credits. We are going to learn to journalize transactions using a double entry system, commonly called debits and credits. Again, we're going to learn more about that later. All right, the second to last step is going to be posting. All right, we are going to post information from the journal to the general ledger accounts. This means that once we record the transactions in the journal, the amounts must be posted to the respective general ledger accounts. So in my previous example, the general ledger accounts would be cash and accounts receivable. By posting the transaction to those accounts, we are able to always and continually have a running balance for each of our accounts. Lastly, we are going to prepare. We are going to prepare and analyze the trial balance and financial statements. This is our final step, and we are going to complete this using the general ledger accounts. After all entries have been posted from the journal, we can compute the end of period balance for every single one of our general ledger accounts. Then we just place those account balances in the correct location on the financial statements. As we are thinking about our account types, I think it helps to refer back to the accounting equation. Assets equal liabilities plus equity. All of our general ledger accounts will fall into one of these three categories. To make our entries in the journal, we are going to use a standard chart of accounts. Now, keep in mind that the chart of accounts will look a bit different for each company. What you'll find in your textbook is a very simple and straightforward chart that's perfect for illustrative purposes and learning the basics of journal entries. For large real-world companies, they might have hundreds of accounts, maybe even thousands in their chart of accounts. What's important to remember, though, about the chart of accounts is that every journal entry must be made to valid general ledger accounts. So let's take a quick look at some of the more common types of general ledger accounts that we can expect to see. So let's begin by walking through some common examples of asset accounts. Now, you'll recall that assets are economic resources that we own or control and that are expected to provide us with future benefits. So let's look at some very common examples. The first one you see here is cash. Sometimes on a balance sheet, you may see this listed as cash and cash equivalents. This is basically any cash that the company has on hand, and that includes electronic cash that is sitting in a bank account. Accounts receivable. This is money owed to us by customers for goods or services that we have provided to them on credit. Now, notes receivable is pretty similar to accounts receivable, but notes receivable are generally more formal arrangements. They're generally for a longer period of time, and they typically include an element of interest expense. So that's the easiest way to distinguish between accounts receivable and notes receivable. General receivables established in the normal course of business, often called trade receivables, those are our accounts receivable. All right, inventory, okay? And I'm going to make a point here because we see inventory over here and we see supplies over here. So I'm going to tell you how to distinguish between the two of these accounts. Inventory is specifically goods that we have purchased for the purpose of reselling it to customers, okay? So this would be goods that we are going to sell in our normal course of business operations. Supplies, on the other hand, we are not going to sell to customers. We are going to use these in our business. This could be things like office supplies or maybe supplies that are used out in the factory, those types of things. We're not holding them for resale. That's the real distinction there. And then here in the middle, prepaid accounts. This is basically expenses that we have paid for up front, okay? So we've not yet incurred the expense, but we have made the payment. And in the next video, we are going to look at some examples of how that plays out from a transaction perspective. But just know that initially prepaids are recorded as assets. And then the bottom three items that you see here, this is what we often call our fixed assets or property, plant, and equipment, PPE. These are the long-term assets that are used in the operation of the business. Okay, liabilities. Remember, liabilities are simply what we owe to others. Okay, and I can tell you one thing that will immediately tell you that you're looking at a liability, anything that has the word payable in there. What you see here on the screen, accounts payable and notes payable, these are just a couple of examples. You could also have, interest payable and taxes payable and salaries payable and wages payable and all sorts of things. If you see the word payable, you know that you are looking at a liability account. Similar to accounts receivable, accounts payable, these are the payables that we incur in our normal business operations. This is basically when we incur an expense now and we're going to pay for it later. You can think of just about anything, whether it's a telephone bill, maybe it's rent or utilities, anything along these lines, anything that you purchase at one point and you pay it at a later date. Similarly, notes payable, these are the more formal arrangements, normally for a longer period of time, and they normally include an element of interest expense. Accrued liabilities, we will learn more about these in one of the upcoming lecture, but these are essentially expenses that we are going to go ahead and report on the income statement, but we haven't yet paid them yet, so that's why we're going to carry them in the liabilities. Again, don't worry too much about that for now. We'll look at some examples of that in one of the upcoming lecture videos. Unearned revenue. Sometimes you'll also see this referred to as deferred revenue. This occurs when a customer has paid us up front and we owe them a good or service. So this is the rare example of a time when our liability isn't necessarily owing cash. It could be owing the customer whatever good or service they've already paid for. Lastly, we've got some equity accounts. Common stock. Common stock. This is how the investors have bought into the company. They purchase common stock and the company gets cash in exchange. Now, what we're going to learn is common stock is recorded at par value. Now, sometimes investors may pay more than par value for the stock. Normally, they will. In such case, the additional amount that is paid in excess of par goes into what we call an additional paid-in capital account. Sometimes you'll see this called paid-in capital in excess of par. It's just the amount that was paid for the stock that exceeds the par value. Okay? Now, dividends. The interesting thing about dividends is actually going to decrease our equity rather than increase it. Dividends are when we use our retained earnings in the business and we pay those out to shareholders. We distribute the monies out to shareholders in the form of dividends. And the last element here of equity is our retained earnings. And this is basically going to represent an accumulation of the company's net income or net loss since the beginning of the business. So it's going to be an accumulation of all revenues and all expenses incurred by the business since the inception. All right, so now we're going to look at a concept called T accounts. And one thing that I want to point out here with a T account is really a visual representation that we use in textbook world, okay? So if you're working for a real world company, you're not going to go on their books and find yourself a T account. What you're going to find are general ledger accounts. But in textbook world, it is a little bit too cumbersome to try to look at an actual general ledger account. So what they do is they use T accounts to symbolize a given general ledger account. For example, we might consider this to be the cash account, okay? And this allows us to see what is going on in the cash account over here and over here. Okay, and this brings us to what we were talking about, which is the double entry bookkeeping system. Okay, the double entry bookkeeping system, also called debits and credits. All right, the basic premise of this is that every transaction must affect at least two general ledger accounts, and the total debits and total credits of each entry must be equal. Okay. Debits always go on the left side and credits always go on the right side. All right. Now we're going to learn something super important. The word debit just means left side and the word credit just means right side. It does not mean increase or decrease. Instead, the impact that a debit or credit has on a given account is going to vary depending on the account type. And that's what we are going to look at next. What you see here on your screen demonstrates the rules of debits and credits, okay? So let's start by focusing on the top row, because if you can master these, then the rest becomes fairly simple, okay? So in the top row, what you see here is the accounting equation, assets equal liabilities plus equity. Okay, so for asset accounts, we debit to increase and we credit to decrease. Liabilities and equity are going to behave in just the opposite way because they are on the opposite side of the equation. Okay, so for liabilities and equity, we are going to debit to decrease and we are going to credit to increase. Now, I do want to stop here and clarify one point because there is one common point of confusion that always arises. Let's go back to this assets, okay? we decided that a debit increases and a credit decreases, okay? And this is going to be true for all asset accounts, including cash, okay? Now, you might be thinking, wait a minute, this is different from how it works on my bank statement. Right, you are. It's because your bank statement is from the perspective of the bank, and from their perspective, your bank statement doesn't represent cash. It represents a liability for the bank. They are holding on to money that belongs to you, and they owe you that money anytime that you decide to ask for it. All right, I don't want to get too much in the weeds here in regards to bank statements, but I felt like that super simple explanation might help you to get over the hump of why debits and credits look different for accounting purposes than they look on your bank statement, okay? It's because even though the bank statement represents cash to you, it doesn't represent cash to the bank. It's a liability for them, and that's the reason that the debits and credits are opposite of what we see here, okay? So let's go back to our chart, okay? So for accounting purposes, all assets are going to behave this way. We are going to debit them to increase them. We're going to credit to decrease them. And again, liabilities and equity are going to be exactly the opposite, okay? They are going to increase with credits and decrease with debits, all right? Now we're going to move down here to this second row. Now, what you're going to notice about this second row is all three of these items are actually part of equity, okay? Now, in order for these three items to make sense in terms of how they behave, I think it helps to think about how they affect equity. So let's start with revenue, okay? Revenue increases our equity. Because it increases our equity, the debits and credits are going to behave exactly the same as they do in equity accounts, okay? Revenue behaves just like equity because it increases equity. Expenses and dividends, on the other hand, decrease equity. Expenses and dividends have a negative impact on equity. Because they negatively affect equity, they are going to behave just the opposite of equity. So for expenses and dividends, we are going to debit to increase and we are going to credit to decrease. Okay? Again, we'll go over that real quick again. Okay? So equity. Revenue behaves just like equity because it increases equity. Expenses and dividends behave just the opposite of equity because they negatively affect equity or they decrease equity. Okay? Now, in terms of using this chart to make your journal entries, all right, you have some choices here. First, my recommendation is just to keep a copy of this chart handy as you're doing journal entries and refer back to it. Another option is to just learn and memorize the rules of debits and credits for different account types. Another option, I can tell you right now, if you just Google easy ways to remember debits and credits, there are all sorts of little acronyms out there. I've seen people, there's some little way that you can do on your fingers, to try to remember it. Totally up to you. Do what works for you. But I recommend just keeping a copy of a chart like this handy when you're doing those journal entries. That way you can easily see how debits and credits are going to affect each account. Okay? So let's do a quick summary here. This is a quick recap of how our transaction analysis process is going to play out. You can see that we are essentially between steps 2 and 3. Okay, so we've kind of looked at what a double entry accounting system looks like, and now we are ready to start recording journal entries using debits and credits. So Let's look at a basic journal entry format. And here's what you are going to notice. This is a standard format for a journal entry. They are always going to be in this basic format, okay? You're going to have your date over here on the left. Then in the center column, you're going to have your accounts. You always start with the general ledger account that you want to debit. You always indent for the credit. The credit always comes second, and you indent and you list the general ledger account that you want to credit here. The debit amount goes in this column. Credit amount goes in this column. Again, debits and credits must be equal. And then we include a description of the transaction. And again, as you're preparing each journal entry, you can just refer back to the little chart here with your debit and credit rules. So let's look at some sample journal entries for some very common types of transactions. Okay, so sample entry 1. Courtney starts a new consulting business on January 1st. She contributes $25,000 cash to the business in exchange for $25,000 in common stock. Okay, so we're going to look over here at our accounting equation. First thing we're going to need to determine is which accounts are going to be affected. Well, she contributes cash to the business, so cash is going to increase. In exchange for that cash, we issue common stock. So common stock is also going to need to increase. Cash is an asset account. We debit to increase. Common stock is an equity account. We credit to increase. So this is what our journal entry is going to look like. On January 1st, we're going to debit cash, credit common stock, $25,000. Our description, we received investment from the owner in exchange for common stock. On January 2nd, Courtney performs $300 in services for a client. She provides them an invoice and they will pay it at a later time, okay? Anytime we are providing a customer with a good or service and we are allowing them to pay at a later time, that's a red flag to you that we are looking at an accounts receivable, okay? The customer's going to owe us that money, okay? But remember, we recognize revenue when we earn it. All right, so let's think about our accounts that are affected here, okay? The customer is going to pay us at a later time, so that's accounts receivable. Accounts receivable is an asset, okay? For assets, we debit to increase, all right? We also need to increase our revenue because we've earned that revenue. We performed the services. For revenues, we are going to credit to increase. All right, so our entry, date, January 2nd. Account to debit is going to be accounts receivable, $300. Account to credit is going to be consulting revenue, $300. We are increasing accounts receivable, and we are also increasing revenue. Description, perform consulting services on credit. On January 5th, Courtney purchases $200 in office supplies on credit, okay? Anytime you see this on credit, that is a sign that you are going to have a payable, okay? So we think, okay, what are our accounts affected? Well, we got $200 in office supplies, so office supplies needs to increase, and we paid it on credit, or we purchased it on credit. So we're going to need to increase the accounts payable account. So for our journal entry, we're going to have January 5th. Our account to debit is going to be office supplies because we can look here. Office supplies is an asset, and in our chart, we can see that we debit an asset account to increase it, okay? Accounts payable is a liability. Therefore, we're going to credit to increase the liability. Debit, office supplies, $200. Credit, accounts payable, $200. Our description, purchase supplies on credit. All right, on January 8th, Courtney pays $1,000 for the current month's office rent, okay? So she is essentially paying an expense in cash, okay? So we need to increase our rent expense. So if we look down here in our debit and credit table, we can see that expenses are increased with a debit. And she paid in cash, so we need to decrease the cash account. All right, so cash is an asset. We are going to credit to decrease cash. Debit rent expense, credit cash for $1,000, and the description paid rent. All right, guys, one more. On January 12th, the customer from the January 2nd sales transaction pays their invoice of $300. Now, I wanted to include one like this simply because it shows you that both the debit and the credit can happen within one category of accounts, okay? In this case, our two accounts are cash and accounts receivable. Both of them are assets. So we are going to increase one asset and we are going to decrease another asset, okay? So we're going to debit cash for $300 because we received the $300. We're going to credit accounts receivable, which decreases the account. We want to decrease that account because when the customer pays us, they no longer owe us that money. So debit cash, credit accounts receivable for $300, and explanation is we received payment from customer. So I hope that this quick lecture on debits and credits has been helpful to you, and I will look forward to seeing you in the next video.